Carson became the host of a daytime game show whose title sounds as if it came out of today's financial headlines. It was called, Who Do You Trust? And that's the question on which we've been focusing here for many months, seeking always to identify for you those who really are the best and most reliable guides through these dark and dangerous financial times, and also to do the probing and ask the questions that you would want asked of those in the most powerful and influential positions. That's the part of our mission we'll be pursuing tonight, where my guest will be the #1 man of the #1 brokerage firm, a firm whose own credibility has come into question, and which in late May agreed to a $100 million settlement with New York's Attorney General after revelations that self-important internet analysts were mocking in private the recommendations they were making in public. It should be a lively chat, and we'll be getting into many other sensitive areas as well. But if Merrill Lynch has now become to many the poster child for brokerage house cynicism, it's increasingly apparent that in reality it has had a lot of company in Wall Street, where fair treatment of individual investors too often lately seems to have become a priority well south of boosting the bottom line. Indeed, several barrages of new brokerage house commercials are now exploding with the suggestion that they represent the only honest game in town. No wonder the reaction of the average investor has been to declare a plague on all their brokerage houses. Such reactions are not uncommon in the periodic bear markets through which long-term investors learn to suffer. Conspiracy theories are always easy to buy when prices keep falling. Few investors complained when analyst recommendations were a source of profits, not pain. But something new has been added this time around. And it's not just the accumulation of public scandals, corporate, accounting, and personal, that have so understandably outraged us all. What's adding to the angst is a sense that the world itself has become less trustworthy, that authentic reasons to be frightened have moved from teenage horror movies to our own homeland, as it will be called in a new cabinet department. So it's not just that we no longer trust financial analysts at the moment, nor, in fact, is that even strictly true, as we saw again this week when the analysts deliver negative opinions, as they did, for example, when Intel offered a disappointing revenue forecast. People still will follow their leads swiftly. It's just that hardly anybody at this point is willing to be swayed by any good news. Far more impressed, for example, that business investment spending has not yet gotten a vigorous new set of legs than that the overall economy is clearly on the rebound. Are we yet at the point the technicians yearn for? The total investor capitulation that often signals the start of a new bull market? That's not clear yet. But what is evident is that investors have moved to a point well beyond just plain skeptical. And instead of asking, when will the market recover, the question overhanging the world of money today is simply, who do you trust? And as the Dow Jones Industrial Average indicates, even a bounce back from a steep Friday morning sell-off couldn't salvage a depressing week in which stocks moved down toward their September lows. None of the broader indexes gave investors anything to cheer about, with the technology-driven NASDAQ again the worst hit. After being battered in 2000 and 2001, NASDAQ is now down another 21.3% in 2002. There were few obvious places for investors to hide. Both gold and bonds lost a bit for the week, and the U.S. dollar touched 17-month lows against the long-scorned euro, in a cloud of worldwide doubts about the U.S. economy and stock market. Really a fun week, huh? And pursuing our theme of whom you can trust, if too many of the people you've counted on lately have turned out to be pigs, have you ever thought of painting them? About 40 works of swine art have been entered in the 7th annual Picasso exhibit in Des Moines. It's not yet known which pig-loving painter will bring home the bacon, but I guess there's a little ham in all of us. Frank Cappiello, whom do you trust these days?
Well, outside of you, Lou, I don't know who else, really, to tell you the truth.
Have you seen this much distrust in the market before?
It's been a long time. You go back to the late 70s or the mid-70s, you had some of this, but this is the market. These declines are either scaring people out or wearing them out. And I think the wear-out factor is pretty high. But I think it all comes down to, in a sense, credibility. Credibility of analysts, credibility of corporations. But more than that, I think people are saying to themselves, what I'm hearing is, well, all this money's in place. All these interest rates are down. And how come the economy is so slow to recover? Why doesn't it recover faster? And the answer you have to give them is, well, it took a long time, to unreel this mess we got into. But it's very disconcerting. People have lost confidence, you're right.
Some people say that the market is still overvalued.
Yes, some people do say that, Lou.
Do you concur?
Well, my opinion is not as important as the Federal Reserve. The Federal Reserve's model of the stock market at this point indicates that the S&P is really undervalued.
Undervalued?
Undervalued, and they haven't said that since
Does the S&P know that?
Well, I don't think the S&P answers questions, Lou.
I thought the Federal Reserve had stopped predicting stock market movements.
Alan Greenspan is still in business, I think.
So what should people do if they're scared out or if they wear out?
Well, I think you got to look at where the problems are, and the problems are still in high tech and in telecom. And while I'm very bullish on some of these telecom stocks, for the average investor, he or she should go where the action is, and the action's with the consumer. So I would go with the retailing stocks. I still think they're attractive. The consumer is still holding up. And two stocks that I like would be Federated Department Stores, and a real speculation would be Gap, the Gap stores, which could be in a
had a tough 2 years.
Huh?
They've had a tough 2 years.
Yes, exactly. And they're in a process now of restructuring. They're going to get a new head of the company. They've got the sales. What they need is some efficiency and some basic, what I call basic management, instead of trying to follow the fads.
Can the consumer continue to carry the recovery?
Yeah, big worry. One of the things that keeps the consumer confident is while the stock market's gone down, their houses have gone up. Housing prices, as long as they go up, the consumer looks at his single biggest possession and he says, I'm okay. Once housing prices stabilize and start to go down, we better get business investment going, because then the consumer may get worried. But to date, there doesn't seem any sign that the housing market has abated. I mean, there have been a lot of scares, but nothing real. People still want houses, 7% mortgage, 7% average increase in prices.
So you think that these stocks, which have been leaders, home building, home improvement stocks,
yes,
will continue to be leaders?
I do. I'd be very careful about how much I put into them, but I think the trend is still up. But I'd much rather have a retailing stock, Lou, in this environment.
Roger McNamee, nobody knows more about the woes and the whizzes of Silicon Valley than you do. Mostly woes these days, isn't it?
Well, Lou, we're going through a major restructuring out in Silicon Valley, and candidly, it's been long overdue. We've talked about it on the show before, that when you go through a 10-year period, as we did in the 90s, inevitably excesses build up, and they build up inside the companies as well. And if you look inside the semiconductor industry, enterprise software, and telecommunications, those three industries are in the beginning of very difficult transformations they're going to be painful. But you know what? Within a few years, they will be done. And the great thing about the technology market is there is always something new. I think for investors, this is an important time to be patient, though, because this is not a period in which we're going to get rich from technology stocks.
A few years sounds like a long time to people these days.
Well, I think longer time horizons are appropriate for everyone. If you must do something in technology today, and I don't think you want to be heavily weighted there, I think that Frank's point about the consumer is correct. You do see all sorts of really exciting consumer electronics products. The new video game platforms are exciting. We happen to own Take-Two Entertainment, which is a player in that market. We also see some interesting things on consumer internet. Overture is a player there. But frankly, I think this is a time to keep your powder dry, and I believe you want to be looking over the summer for despair to set in among technology investors, and I think then it'll be possible to do some really strategic long-term investing in the best positioned companies for the next wave.
Some people have talked about a matter of months before the basic industry picked up. You're suggesting years.
I think that that is true, and I'm afraid that it's true because it makes my job a lot less fun than it would be if it were only a matter of months away. But I think that is the reality. There are just too many industries that need to be restructured, and frankly, customers, particularly large corporations, have learned to do with a little bit less technology than they bought before.
And why you recommend any technology stocks at all?
Well, as I said, the consumer is strong right now, and I believe that we will see within a matter of months a level of despair building up among investors that will make these stocks cheap enough that it'll be really good to be an investor again, to buy these stocks to hold for a period of years. And
I mean, the ones that are down 90% would be down 95%?
or perhaps even 99%.
Oh, that's certainly cheerful news, and I thank you for cheering us all up. Mike Holland, do you agree with anything you've heard?
I think I'm leaving after Roger just finished with his comments. No, I agree with the a number of the comments, but I would focus in on something which is the where the individuals are. Many years ago, in a previous bear market, a successful presidential candidate referred to the misery index, which was the combination, if you added up the inflation rate and unemployment.
That would be Jimmy Carter.
That would, that's right. And he actually won by reminding people that when you have low unemployment and low inflation, that's good. When they're high, that's bad. And if you think how incredible it was that he was able to win, given where he was coming from, we now have the opposite of that. We have extremely low inflation, and coming out of a recession, we have very low unemployment. So I think, as Roger was just saying, we do have the backdrop for the continuation, as Frank was talking about, of very good. Two-thirds of the economy is the consumer. The consumer may not be buying PCs right now, but he and she are doing a hell of a job buying things at places like Walmart. Walmart this week, once again, the world's largest retailer, announced wonderful sales, up over 6%. People were expecting maybe 4%. And this is supposed to be in a recessionary, gloomy environment. The best companies, the Walmarts, the Microsofts, the GEs, are actually, in their consumer areas, doing extremely well.
These are areas, particularly, you mentioned a GE and a Microsoft, that have been conspicuously out of favor. What's going to get them back into favor?
Oh, I think the bifurcation we have right now between reality, which is the economy doing better and the consumer doing just fine, thank you, and sentiment, which is very gloomy. I think both of those companies that you mentioned, Microsoft and GE, will once again, at some point in the future, yet undefined, do extremely well in the stock market. I think as the economy does better, they can't afford not to.
I won't have to wait years.
I don't think so, as a matter of fact. I think it could be sooner.
All righty, and now, folks, a reminder of how easy it is to communicate with us here at Louis Rukeyser's Wall Street. Our new email address couldn't be simpler. It's just lou@cnbc.com, and I truly do love to hear from you. And now let's go over and meet tonight's special guest, David H. Komansky. Dave, welcome. Thank you for coming.
It's my pleasure, Lou. It's always good to see you.
Please. Dave Komansky undoubtedly wished for a happier way to end his days at Merrill Lynch, where he's worked for more than 30 years, becoming CEO in December 1996 and adding the title of chairman 4 months later. He's scheduled to retire in 2004. Dave, how embarrassed is Merrill Lynch now? A number of viewers noted that while you expressed sorrow about the indiscreet emails by some of your analysts, the company never admitted any wrongdoing. Why not?
Well, I think you know our firm pretty well, Lou. One of the things that we are most proud of is the fabric of our firm, otherwise known as the culture of our firm. We have a set of principles that we've stood for almost 100 years. To a certain extent, some of these emails violated both the spirit and the principle of what we stand for, and we were very embarrassed by it. Unfortunately, 800 professionals around the world were tainted by the activities of a relatively small handful of people.
Anybody can be wrong about the market. Indeed, at one time or another, everybody is wrong about the market. But there's been a suggestion now that some of the Merrill overly bullish reports may have been duplicitous.
Thank you for watching, and remember to like, comment, and subscribe.